Hi there, it's Christian Dy, Latitude West Financial. It is July 10th, 2021. Thank you for joining us for cash flowing real estate in Vancouver, question mark. So the big question is there any cash flowing real estate here in our expensive Vancouver market? So my special guest is Gary Wong from McDonald Realty. And Gary is a realtor and has been for many, many years. He has been very, very successful in analyzing and helping his clients to figure out what is a great investment. He has a really nice luxury home sales system, as well as a real estate acquisition formula, which we're going to see a little bit more about. He's won a great deal of real estate board medallion club member awards, being in the top 10% for several years. But I think, everyone wants to kind of get into it. So Gary's going to be our expert for today, and he's going to take a look at the areas which he finds to say these are still the cash flowing areas in Vancouver. So 3 overlooked real estate goldmine areas in Vancouver by Gary, and then let's get right into it. So, like I said, Gary has also written a book on Vancouver real estate. At the end of the webinar, we'll let you know how you can get a copy of this book complimentary. Gary, let's talk about your top 3 areas. The first one is Richmond Brighouse area. All right, go ahead, Gary.
Hi, everyone. So this is a map of Vancouver, and there are 3 areas that I'd like to talk about. The first area that I usually focus on is Richmond, and the area that within Richmond, in the next slide, would be the area which is called Brickhouse. And Brickhouse, as you can see in the middle of the screen, it says Brickhouse is right beside Richmond Center. To the north of that, there is Lansdowne Mall. To the south of that is Richmond Center. The area I like to focus on is beside Lansdowne Mall is Kwantlen University. So in that vicinity, I would say that is the most popular area, in my opinion, as a great place to invest your money. So if you take a look at the next slide, it shows the borders of the Brickhouse location. So in the turquoise green location, that is the area that I'd like us to focus on. And the 3 reasons why I like this area is, number one, the town center effect. So what is the town center effect? Town center effect is when the city of a municipality wants to increase the zoning in a particular area, usually near the shopping malls. So Metrotown has done that, Brentwood Mall has done that, Lougheed Center has done that. And the next area that they are going to do that is Lansdowne Mall. They're also doing that for Richmond Center. But I think Lansdowne Mall is one of the locations that it's not, it's still somewhat affordable, in my opinion. So there's high redevelopment potential. The town center effect is when they build high rises at the mall, then the vicinity, the property prices will go up. Obviously, when they build high rises in the center of Metrotown, the older buildings or the older units around Metrotown will increase in value. And so I see that, and I tell my clients to buy around the town center, around the mall, right? So then the second reason why I like that area is the central location. Because it's a central location, just like downtown, just like Oak Ridge, just like Brentwood Mall, the asset appreciation and high rental demand. So what makes this a central location? Well, next door is the school, Kwantlen University. There's the shopping mall, Lansdowne Mall. There's the transit, which is Lansdowne SkyTrain Station, the Canada Line. And then I look at the population growth. Well, how do you know population growth, Gary? Do I have to look at Statistics Canada and look at all this? No. You just look at the big box stores and see where they set up shop. So one of the things I learned in business school was Burger King often copied McDonald's in terms of where to set up shop. They knew that McDonald's did a bunch of research. So then they would just set up shop close to the McDonald's. That's what Burger King would do. So what I tell my clients is, okay, look at where Best Buy is setting up shop. Look at where Costco is setting up shop, Walmart, those big box stores, and you kind of know which area is going to have high population growth.
Yeah,
And then,
yeah, Gary, can you hear me okay?
yeah, I can hear you. Okay.
Yeah, I wanted to add on to that, I've been investing in real estate for many, many years, and the big box method is really a way of shortcutting all of the research. Because when a big box store, I remember when the big box stores, and this was, 20 years ago, when they started to go to Langley, when they started to go to Abbotsford, and there was almost nothing out there. And if you take a look what's out there now, they did all their homework. They weren't going to spend multi-millions of dollars to set up, a huge Costco or a huge Best Buy in an area where they didn't believe that they were already speaking with the city about the plans for the future to go in there. So I really like the idea that you have over here. And this area wasn't on my radar at all. So I'm really, really liking the information that you're sharing with us. Whenever I like to buy a property, I always like to buy in a place where there are institutions that cannot be moved that are also recession proof. So the one that you're describing over here in your first bullet point is Kwantlen. They will always, always be these educational institutions which will create a demand for rentals.
Right.
As well as, it doesn't matter if COVID hits, it doesn't matter what happens, schools continue to operate in some capacity. And the next one I really like is the third bullet point is the transit. When I was investing in Surrey back in the 90s, I had places right beside transit, and I had places several blocks away from transit, and they were almost the exact same price when I bought them. 10 years later, the ones that were right beside the transit had appreciated significantly more than the ones that weren't literally like within walking distance of that transit over there. So I really like the research that you've created over here in this area.
Yeah, definitely. I learned all this stuff when I attended different real estate investing seminars over the years. And then I just basically, I saw that a lot of the real estate investing clubs, they're like, you have to pay to join it. But I took the information, I put it in my book, and I also give it away to my clients who don't necessarily have access to this information on a regular basis.
No, that's great. That's great. So here your third point says the big
Yeah.
price boom has not occurred
Correct.
yet.
So Metrotown, unlike Metrotown, Brentwood, Lougheed, where the vicinity, the areas around the town center have already appreciated, have already boomed. I found that around Brickhouse, around Lansdowne specifically, the prices have not boomed. The older condos in that area have not boomed, even though the older condos, typically they are part of older buildings that will be redeveloped in the future. When the town center increases rezoning, increases in the floor space ratio, the vicinity often has a similar effect, just like Metrotown. So when Metrotown went up, all the vicinity, like the older buildings around the area, all got rezoned. I'm not saying that's a guarantee right away for Brickhouse, but that is a long-term plan of the city. And so the big price boom has not occurred in around Lansdowne and Richmond Center. And so I think that's a great sign. You're basically buying before the prices skyrocket.
So I had a client who had a house. It wasn't a very nice house out in Surrey.
Mhm.
And this was several years back. And basically, somebody wanted to build a very, very large townhouse complex where basically him and his neighbors were. And it was actually on a really busy street in Surrey.
Mhm.
They got significantly more than what that house was worth. Is that what you're talking about here, Gary?
That's so what happens is the developer will buy the buildings around Lansdowne Mall. And then they will buy those older buildings. And then let's say you own a condo. And then if you sell your condo, you're probably getting what, close to tax assessed or maybe 10% over tax assessed or something like that. But what happens when there's a strata windup? Strata windup is when the developer wants to buy the building. They need 80% vote saying that we will sell the building. Developers will typically pay a premium up to 2 or 3 times your tax assessed.
Oh, wow. 2 or
Yeah,
3 times. Wow.
up to, right?
Yeah, yeah.
And depending on the floor space ratio that they can get, right, with the city.
Got
And
it.
so that's just cream. I tell my clients who buy these older condos, hey, that's just icing on top of the cake.
Yeah.
Like that might not happen for like 2, 3, 5 years. So don't bank on that right away. But then let's not talk about being a strata windup. Let's just talk about rental demand and the price of the property. It's very low. And so I go into actually examples after that, right? But we'll talk about the pros and cons just to sum it up. The pros of Brick House, it's the lowest price rental condos in a central area in Greater Vancouver. I don't know anywhere in like Vancouver, Richmond, Burnaby, where you can buy rentable condos at $300,000 to $400,000 price range.
Yeah.
Really, I looked at all the areas. Unless you go out to like Surrey, the Fraser Valley, you can't really buy $300,000, $400,000 rentable condos in the group, like in the Vancouver area. And so the second reason, the other reason I like it is the high rental rate relative to the condo price. Sure, I can buy a condo in downtown for $600,000, $700,000, but then the rental rate is lower like it's higher, but then relative to the price of the condo, it's quite different, you know. And I can go into specific details on that part, but later. The next point is the low rental vacancy rate because of the location of the SkyTrain, the location of the mall, the location of Walmart. So there's because when the condo is located close to a mall, you know that job growth is quite high there. So there's a lot of opportunities for employment. Same with the school. And so there will be people renting. And so I know there's a low rental vacancy rate in that area.
Got it. Got it.
The
Now let's,
cons,
yeah,
sorry,
here
go
comes
ahead.
the bad news. Here comes the bad news. The
Yeah.
con.
So the cons is you would need about a 35% down, sorry, 65% loan to value or 35% down payment for a positive cash flow. Okay. And then certain older condo buildings in that area, although they are pretty cheap, 300 to 400,000, some of them have higher maintenance costs. Okay. The older condos often also have a lower asset appreciation rate. So I can go into a lot more detail, but basically older condos have higher cash flow relative to the price. Like newer condos typically have lower cash flow relative to the price of the condo.
Yeah, absolutely. That was actually the point I was trying to get to all the viewers over here, is trying to figure out cash flowing cash flowing real estate in Vancouver. Is it possible? You're saying it is possible based off of the down payment.
That's right. Right.
In this particular area over here, the down payment, we have quite a high number over here. Let's be transparent.
It's
35%
35% low, 35% down,
Yeah,
65% loan to value.
that's right. That's
Yeah,
right. But at the same time, the reason why people have continued to invest in Vancouver is because we have a much better capital appreciation
that's right.
over, let's say, a 5 or 10 year period, as opposed to if we went to Winnipeg. You know, we
That's
might
right.
get the cash flow in Winnipeg, but the problem is the capital appreciation might be at 1 or 2%. Whereas in Vancouver, we sometimes see these crazy numbers. And what you've done over here for us for Break House is saying it's got an even higher potential because of the transit, because of the rezoning.
That's correct. That's correct.
Yeah, so let's get into this next one over here, and let's do a case study.
Yeah.
Now Gary has been kind enough to actually pick up active listing right now, and it's not your active listing; it's just a
Yeah.
active listing.
Yeah.
And we decided to dissect it over here. So tell us about this listing a little bit.
So this listing, I just did a search in the Brick House area. It has to have rentals allowed. It has to have either rentals allowed or no restrictions. I just picked the cheapest unit. The cheapest unit happens to be this 8451 Westminster Highway, 378,000, which is very typical for this area. Somewhere in the mid 300s, sometimes in the 400s for the like 2 bedrooms. So as you can see, it's 628 square feet, which is pretty decent. It's a pretty spacious 1 bedroom. You can see the maintenance fee is about $437. The property tax is around $895 on the top right hand corner. It's built in 1983. I blacked out the listing agent's name and the owner's name, etc.
It looks
But
like they dropped the
pretty decent.
price recently, though.
Yeah, they were at 399,
Yeah.
but it got reduced to 378. So some people might be like, oh, 378, they're trying to do a bidding war. No, no.
Tooling.
You can see that 399, no one was willing to buy it at 399. So they dropped it to 378.
Yeah.
So I can go into specific details of like, okay, so it's worth 378, like what's the rental rate? And that's where I go into the numbers on the next slide.
So now what Gary is doing over here, he's sharing with us his is basically his analysis sheet. And at the end, if anyone wanted to go through a property on their own with Gary, he's willing to do that with you, complimentary. So walk us through how you do your analysis and where you're getting our projected cash flow, our net income as percentage of equity, and our return on investment.
Okay, so for this particular property, the typical rental rate in that area for a 1 bedroom, 1 bath, anywhere between 15 to 1600. So I just put 1600 just to be, because I looked at the pictures, they look in decent condition. It's around 1600. So then I put in like, there's a column on the left that says if you charge extra for underground parking and then I put in a projected vacancy and I took the vacancy rate of Vancouver, which is generally around 0.8 to 1%. So I put that as a cost, right? And then so I put in 1280. So you're looking at 1587 of net rental income. I put in the condo fees. Okay, strata fees of $437 per month. I put in property tax. So I took the $890 divided by 12. It's about $74. I have on my spreadsheet, I have mortgage payment. So I just took like an arbitrary number of about 2%. This is based on a 30-year amortization. So your monthly payment and of 35% down. So it would be about $908 for your mortgage payment. So I did a calculation of the expense, like revenue minus expenses. So 1587 minus 511 minus your mortgage minus any insurance. It's about $30 a month. And then repairs and maintenance, just in case if you need to maintain the property. So you just put it as like a contingency.
So that's your capital expenditure, but that's not your strata fee though.
No, that's not your strata fee. So the repairs and maintenance, let's say there was some levy or whatever you needed to or you needed to replace something for your rental property.
And that $100 is monthly, correct?
Yeah, that's correct.
Yeah, because whenever I have a rental property, I'm not going to be losing $100 a month to a capital expenditure.
No,
but over 5 years, I might be losing $5,000 because I got to replace it. So that's
right.
Way, yeah. So almost taking that into account is good. I think a lot of people forget to do that when they're doing their numbers.
That's right. That's right. And then so your projected cash flow per month would be $37.20. And then $37.20 times 12 is $446. So how did I get the 0.3%? I did $446 divided by your down payment. And in this case, your down payment of 35% would be $132,000.
Yeah.
So that would be the 0.3% of your return on investment. And then the next part down is anticipated mortgage reduction, equity, and cash. So the yellow line is called cash on cash.
Yeah.
Like if you just put on cash, what is your return on investment? The second line of the orange is cash on cash plus equity. So many investors forget that a percentage of the rental payment goes towards equity of your property. It doesn't go in specifically cash in your pocket directly, but it goes into paying off the principal in your mortgage. So we calculated it with the Excel spreadsheet, how much of the mortgage payment would go towards principal of your mortgage. It's approximately $6,039. So I added 6,039 plus the 446 equals 6,485. Take that divided by your down payment of 132,000. It is 4.9%. That's called cash on cash plus equity. So on the left side, it says net income as a percentage of equity. Then the last row that talks about that's in green is the potential capital appreciation. So I took a basic number of, okay, let's say the property appreciates 5% a year. And then, so 5% of 378,000 is 18,900. So I took 18,900 plus 6,485, $25,385. Divide that by divide that by your down payment of 132,000 equals 19.2% return. So then that's cash on cash plus equity plus asset appreciation.
Yeah.
And then, yep.
I was just going to comment over here, me being a big numbers guy over here. I liked how you didn't forget to take, the equity as well as the capital appreciation over here. I guess the best way to look at this for those of you guys who out there who are a little bit more advanced in your analysis of investments, especially you stock guys out there, this essentially is comparing against what the stock market is returning. So if I said I'm going to invest the same equivalent down payment of 100 grand or 200 grand, what am I going to get with my stock if over time? The one thing that people do need to remember over here is in year one, if the projections are correct and there's this 25 grand over here, you would then say, hey, I just made 25 grand, but you got to remember, if you were to sell it, there's all these additional costs that we have not taken into account over here. This is just the value of the asset as you hold it. It's the same thing with a stock. If you're holding a non-registered stock and it goes up by 10%, 100 grand, and you've got 10 grand, that doesn't mean you're going to see that 10 grand when you sell it because there's taxation on it. In this case over here, there's potential taxation if it's an investment, but there's also exit fees, there's realtor fees, there's all of those other fees. So really, whenever we're talking about an investment, we don't like to look at it. We like to see where it's going to go, but then we like to remind you that more or less all real estate should be a longer term hold than maybe like a traditional stock where you're buying and selling in and out of it. But Gary, back to you. I really like the analysis you've done over here.
Yeah. And so I like use that's the numbers for year one. So I put year 2, 3, 4, 5, and then every year the numbers you see are a little bit different because I just increased the expenses and I increased the income by 3%. So under the potential capital appreciation of 5%, I put inflation of 3%. So every year your expenses will go up 3%, and every year, assuming you're a landlord who will increase the rent regularly, so I increase the rent 3% every year. And then you can see there's a 5-year projection. And if you guys are interested and you want to find out more details on a specific property, like Christian said at the end of the webinar, if you have a specific property you want me to analyze, feel free to reach out.
And Gary will do this complimentary with
Yes.
his analysis Excel sheet, helping to guide you with your decision.
Exactly.
So what I want to do is I want to jump into the next 2 areas that you liked. And now that we've gone through the worksheet, we can go through it much faster as you analyze these. Okay, Vancouver, Falls Creek / Olympic Village area. Talk to us, Gary.
Okay, so this is the map of the Falls Creek Fairview area. So you can see in the middle of the screen, there's FA. FA stands for Fairview. On the left of that is KT, which is Kitsilano. On the right of that is MP, is Mount Pleasant. And then north of FA is FC, which is Falls Creek. So Falls Creek, you can see Granville Island there. You can see it goes to Yaletown, etc. So Falls Creek is where Olympic Village, you can see the Olympic Village Canada Line station over there on the right side of the FC. And so I'm looking at that area called Olympic Village there. And I like the Falls Creek area because of a couple of different reasons. The first reason I would like to point out is the St. Paul's relocation from downtown Vancouver to that area. It's not relocating to Falls Creek, but very close to Falls Creek. So if you look at the next map, the next page, I put in two different maps. So the map on the top left corner is just a minimized version. So on the right of FC is MP, and to the right of MP is ST. ST is Strathcona. So, and then obviously to the left of ST is downtown, but to the right, so Strathcona, that area in the top right-hand corner, that is actually where St. Paul's is going to be. So I maximized that map into the map below. So you can see like main and terminal, a little bit close to main and terminal, there's a National Avenue. That is actually where St. Paul's is going. So the popularity of Olympic Village is why I like that area, but why I suggest Olympic Village as opposed to Strathcona is because Olympic Village is much more popular than Strathcona. It's much more developed than the tenant profile, the demographic is different from Strathcona. So Strathcona right now is sometimes not perceived in a good light because that area is a little bit run down. It's where the train station is. And so for me to recommend my clients to buy there right now is probably too early. I would tell them more so, hey, why don't you buy this trendy area like Olympic Village? So you can see the third step, the third reason why I love that area is what City of Vancouver plans to do in that area. So like I just put a link there, vancouver.ca. It's basically I Googled it and what's the City of Vancouver Northeast Falls Creek plans. And then they can tell you what are they going to build there? What's the zoning going to look like, etc. So Concord Pacific is also, they own a lot of that area, like where the expo is and etc. And so those areas point to a very like it points to a very desirable location for people to want to live in because there's a lot of development going on. When there's a lot of development going on, population growth will increase in that area. And so Falls Creek is the next location I really like. So to the next slide, I talk about, to summarize, the pros and cons. The pros of Falls Creek, it's a hip and trendy area where tenants are actually willing to pay a premium for. Very similar to downtown, but sometimes people like Olympic Village just because it's more central, they think. It's closer to Vancouver, but they don't have to live in downtown. It's not hustle and bustle like downtown, and they like that area. And I say tenants are willing to pay a premium for because when I look at the like vicinity, like Fairview and like Mount Pleasant, I find that Olympic Village, the tenants are willing to pay a little bit more in Falls Creek or Olympic Village than Fairview or Mount Pleasant. And that's because of the trendiness of that area, like the hip and trendy demographic that lives there.
Yeah, like to jump in over here, I've got a lot of clients who are physicians, and when they're doing the residency, they want a nice place near the hospital. And that's why right now with VGH, that whole area, it is shocking at how much the rent is for what you're getting. Shocking. But when you have these residents who are on call or nurses, they want to be close enough. They'll do a 12-hour shift. They want to just walk back to their place in 6 minutes, go to sleep, get back up to their shift, and they want that place to be nice. I can definitely see how Olympic Village, your call on Olympic Village over Strathcona itself, it has the nice, it's close enough, it's going to be trendy. When someone or a young physician who just finishes the residency, they want a really nice place in a trendy area. I could really see how this might capital appreciate significantly more than, let's say, someplace in East Van or
Yeah,
someplace elsewhere. So I think, again, we're talking about a higher capital appreciation as compared to the other parts of Vancouver.
that's right. That's right. So Falls Creek is actually in the west side of Vancouver. Strathcona is actually East Vancouver. So everyone knows the difference between Vancouver West and Vancouver East. Vancouver West is more desirable. And like in terms of it's more quote unquote premium, right?
Absolutely.
So
All
yeah,
right. So let's
the
hear
second
the,
reason,
yep.
central desirable location, tenants don't mind smaller spaces and parking spot is optional. There are a lot of units in Falls Creek that do not have parking, but tenants don't mind. They still rent those places at a premium. And then a lot of the floor plans are actually smaller. But I find that it's still quite desirable. There's still people buying and selling, still people renting, which tells me that the demographic there they don't really mind that much. Another pro of that area versus like Fairview is Falls Creek is filled with newer buildings there. Fairview is a little bit older, a lot of older buildings. Like you said, Christian, younger physicians, they want to, after their shift, they want to live in a newer building with AC, etc. So the cons of this area is that you need approximately 30% down payment for positive cash flow. And so unlike Brick House, where you can buy a condo for $300,000 to $400,000 for an older condo, there are no older condos in Falls Creek in Olympic Village. They're basically $600,000 to $700,000 entry point for a 1 bedroom, 1 bath, 500 plus square feet condo. The other con is that it's a newer build quality and floor plan, but it's newer. It's a newer unit, but the build quality and floor plans are mediocre, in my opinion. Like I've seen luxury, I've seen entry level. For a newer build, I'm expecting a certain level of quality, and I'm expecting like spacious, very functional floor plans. But because of Olympic Village, when they were built by a developer named Millennium. I looked at the build quality and I looked at the floor plans, and some of the floor plans are quite awkward. Like they would have like a long corridor before like a studio. So a lot of wasted space, but it was regardless of that, people are still renting those areas and people are still buying those properties. So that's one of the cons. Typically, also another con is the high strata fees. So unlike Brick House, even though older condos, you're looking at about 40, 50 cents a square foot. For Olympic Village, you're looking at north of 50 cents a square foot for strata fees. And that's because of air conditioning and such. So that's another con of the Olympic Village area.
All right, let's get into the case study. So
Yeah.
again, we've grabbed an active listing right now. Looks like it's 549,000 over here. It's in the area that we've been describing. Rentals are allowed, pets allowed with restrictions. All right, do you want to comment on this one before we get into the numbers?
Yeah. I'll briefly summarize this. Basically, I took a look. What's the cheapest unit in Olympic Village that is rentable? This was what showed up. A studio, 453 square feet. The reason why I typically recommend over 500 square feet is because it's a little bit harder to get financing when it's under 500 square feet. And so if it's harder to get financing, resale value in the future will be harder because buyers, specifically first-time home buyers, will have a little bit of trouble getting financing for units that are under 500 square feet. So this one is the cheapest unit. Like I said in the previous slide, it's about 600 to 700,000 for entry level. But in this case, studio that has zero parking, 549,000. Pretty good deal in my opinion. This
All
would
right.
probably rent out for around, $2,000, which you can see in my spreadsheet. So I did the same calculation. I put 30% down on this one, 300-year amortize, 360-month amortization, which is 30 years. Rental income, 2,000. So I did the strata fee, 243, property tax, etc., mortgage payment, and I did the repairs and maintenance contingency. You're looking at cash flow of $71 per month. Per year.
2,000 is the projected income for 450 square feet.
Yeah.
Yeah.
And I'm being conservative here.
Yeah, no, I get it. I completely get it. You know, for those people who are interested in doing the analysis off of a one bed or a two bed in that area, I suggest you reach out to Gary, because I would think those places are going to be a fortune for
Yeah,
those people who want to live there. And I guess I'm thinking on the two-bedroom side over here, even if it's like 3,000 a month, but yeah, you get two roommates who are wanting to live in that area, or maybe are, you know, in the future going to be working at St. Paul's or something like that. I could absolutely see why these numbers are going to get a lot better.
yeah, yeah. So if you take a look, I did the same analysis. You're looking at about $71 a month, $855 a year. You're looking at 0.5% positive cash flow per year. Cash on cash plus equity, you're looking at about 6.3% return. And then cash on cash plus equity plus appreciation, you're looking at 22.9% return.
No, these are great. These are
Yeah.
absolutely great. I just want to be mindful of time over here.
Yeah.
I want to now get to your third area, Vancouver West End area.
Yeah. So the West End area, here's a map of the West End. Everyone's familiar with Cole Harbour, West End, and then downtown. So West End is where, English Bay is. And then the reasons why I like West End is on the next slide. Number one is the high latent value. So everyone knows that in downtown, there's all these high rises, but except for West End, it's a whole bunch of low rises. So I know that like being in the industry, I know that developers like Bosa and West Bank, they're buying up units in low rise buildings in the West End. They are planning to, because like I said, we talked about strata windup, you need 80% agreement to sell the building. And so these developers are buying units in these old low-rise buildings so that they have votes. Okay. So then they are going to be tearing down these buildings, and they are going to be building high rises there, obviously with city approval. And city is going to increase the zoning because the value of the land is too much for it to stay as a low rise. So there's high latent value, high redevelopment potential, and there's a ton of rental demand in West End. Everyone wants to live close to the beach, English Bay. It's really nice and trendy. It's downtown. It's the quieter area of downtown, so that there's no it's not like high rises all everywhere you see, right? So those are the three reasons. The pros and cons, I just want to summarize. Close to English Bay, parking is optional for tenant profile. Again, high rental demand. Cons, you need about 30% down payment for positive cash flow. Higher $500,000 to $600,000 entry point for a 1 bedroom, 1 bath, 500 plus square foot condo. And then, like the previous examples, we'll go through a case study in the next slide. So here I just did a search. What's the cheapest unit in West End that's rentable? Found this. Alberni Street. This building is called Lions, the Lions.
Oh yeah,
1999, 469,000 for a bachelor. This one,
400 square feet.
yeah, is 396 square feet. So it's
Wow.
quite small, but the high, it's a good property.
Yeah, like if you're not living in it, if you're the one who's renting it out over here, you know, you want efficiency, you know.
Yep. Yep. So this particular property, like your rental is probably around 1,800, just to be conservative. $1,800 a month. I plugged in the condo fees, I plugged in the mortgage. You're looking at about $60 positive cash flow. Over a year, $723, 0.5% return. The cash on cash plus equity, you're looking at about 6.2% return.
Yeah, I chopped off the green line over there, Gary. You got it in front of you?
Yeah, I got it in front of me. So the cash on cash plus equity plus appreciation, you're looking at about 22.9% return.
Got it. And what is it on year 5?
Year 5, you're looking at 27%. So
20.
every year the appreciation goes up because the tenants paying down your principal. So then actually you're paying less and less interest as you go like through your 30-year amortization, right?
Yeah.
So your returns actually increase over time.
No, this has been really, really good. Like, I really like that we've done a cross section of these three different areas. I
Mhm.
guess because I was skeptical coming into this webinar with you as my guest and saying cash flowing in Vancouver, I don't think it's going to happen. But you've really laid it out, and you basically said, well, it's very, very hard to cash flow in Vancouver, but if you were going to attempt to cash flow in Vancouver to break even, these are the three areas that I would suggest. These are the three price points, as well as saying this is the down payment you would need in order to get that break even.
That's
Now,
right.
if you are willing to not have it cash flow and see it more as an investment over here, then we could run those numbers as well. If someone said, I only have a 20% down payment, but I'm willing to take a minus 200 a month or a minus 250 a month or 300 a month, and then we want to rerun the numbers. That's the whole purpose of working with the team,
That's
to
right.
see, does this make sense over here? And these three areas over here, in my opinion, the big selling point of all three of these is if somebody said, hey, Christian, I want to invest more in real estate, but I only feel confident in staying close to my home in Vancouver. I'm not comfortable going out to, Quebec or Winnipeg or the United States. I want it to be close here. Maybe you've already invested in this area and you've done quite well. You want to continue to invest in your backyard in Vancouver, but where do you start? I think, Gary, you've done an excellent job in narrowing down three areas with a compelling argument why the capital appreciation should cause these to be a very, very solid investment
Yeah.
over time.
Yeah.
This has been really, really fantastic over here. So what I want to do is I want to talk to you guys a little bit about how I can help. At Latitude West, for those of you who are clients, you already know that I'm here to help you, to guide you with your financial planning decisions, whether they be with stocks or with real estate. But the unique part about my company is that I'm a big promoter of real estate, and I'm one of the very, very few financial advisors out there that will actually encourage and help to integrate your real estate decisions, whether it be your own personal home or whether it be an investment property. So we always start with a discovery meeting, and that is complimentary. If you wanted a discovery meeting that was complimentary and just wanted to talk about your scenario, you would tell me a little bit more about you and what you're trying to do, and I would tell you a little bit about how I can help. It would be up to you if we wanted to continue the conversation forward. But all of our discovery meetings are completely complimentary. Then, if we were to work together, we would navigate a plan together. Me and my team would analyze what you're trying to do, and we would come up with a solution. And I'll give you my own little case study over here. A married couple, they own their home. They're thinking of upgrading their home, but they also are thinking of investing. So, should they use the equity in their current home to invest in another property, or should they, maybe start from scratch? So, what are some options? They could sell their house to go buy that larger house and forget about the investment, or they could sell their house, buy a smaller house, and invest in some other real estate property. Now they have two homes, or they could keep the house, leverage the equity out of that house, and then go buy that investment property. So these are very, very common questions that my clients will have for me, and this is the type of analysis that I'll do, because this over here is essentially the $1 million question. Why? Because by the time they retire, it will literally be worth $1 million, or it could be the worst headache they've ever done in their life. But they're not sure, and that's where they need financial advice over here. So I I could do the analysis. I could figure out where you would be in retirement having those two properties, as well as understanding the cash flow to see if it makes sense or not. Not only can I do that, I can push the envelope and show you what it looks like if we were to do three properties, with a 7-year time frame or a 10-year time frame. So my company is big into helping people with real estate decisions, and I think a lot of people, when they go for investment advice with their banks, or they go for investment advice with some independent advisor, it seems to stop short at the real estate. Once it comes to the real estate question, well, pretty much we're not talking about mutual funds and TFSAs anymore. And now the help has seemed to have started, but that's actually where they need the help the most, because those are probably even the larger decisions that need to be made. So what is the value of using an advisor? statistics have shown, over a 15-year time frame, people who used an advisor versus not using advisor had almost a 3 times greater wealth. And I see it all the time. I've got clients, and when they're not sure what to do, they weren't sure whether to invest during COVID or not because the markets were down, both the real estate and the stock market. That decision alone cost them thousands of dollars. Why? Because that was the best time to invest. Take a look at our real estate market right now. Take a look at where the stock market is right now. Having somebody who can analyze and be able to guide those decisions is what's going to cause the greatest amount of impact. It's not so much the investment itself, it's the advice on whether to do the investment and what's the right investment. That's where all the value is. And for many people, they can't figure that out on their own. So right now, I want to be mindful of time over here. Now is the time for those who are on the live call to ask their questions by putting it in the chat. So feel free to formulate your questions in the chat, and I will field the questions one at a time. So while you are doing that, I'm also going to say, for those of you listening, please visit our website for our next webinar with Gary. So we didn't have enough time to do the entire Lower Mainland. We just had enough time to do pretty much Vancouver, Vancouver with Richmond over here. But what about the Fraser Valley? Where's the cash flowing real estate in the Fraser Valley? Is it Langley? Is it Abbotsford? Is it Chilliwack? Is it Mission? Is it Victoria? Like, where is the next places that we should be looking over here? So what I want to do is I want to invite people to sign up for the next one. And the next one is August 14th, where I'm going to have Gary back as my guest. He's going to do that analysis. He's going to pick those case studies, and he's going to narrow down to his top 3 areas of where in the Lower Mainland / Fraser Valley is the best cash flowing real estate. So feel free to sign up at latitude-west.ca /workshops. It should be there now on the for August for the August 14th. So if you want to see a little bit more about Gary, Gary has got this YouTube channel at www.vancouverrealestatetv.com. And Gary, is that where we could see more of your videos?
Yes. So that's just a link that redirects you to my YouTube channel, or you can just search my name on YouTube, right? Gary Wong, real estate, and then I'm there. So I have about over 570 videos on there. Yeah.
And then over here, also your podcast, you'd be able to see that on your website as well, correct?
That's right. That's on my website.
Perfect. And then you said that you'd be willing to share your book, Vancouver Real Estate, with our listeners. How can they get a copy of that book complimentary?
Yeah, if they if they're local in Vancouver, I can meet up with them for a consultation and then also give them a copy of my book, either Chinese or English. And then let's say they are out of town, then I can email a copy of my ebook to them. Yep.
Perfect. And then the last thing that Gary was offering is that if anybody had a property that they wanted to assess and they really like that analysis that he did for our 3 case studies over here, he'd be happy to complimentary to go through it with you if you want to connect with him. So what I want to do over here, we did have one question. And then this one question is, what about other parts in Canada, in the East Coast, or in Quebec? That would be a better question probably for me directly. And I'll show you how you can, because I actually do a lot of real estate investment with my real estate investment advising with my clients across Canada. So Alberta, Ontario, and different parts. So for that question, feel free to connect with me directly, and then I will, and then I'll be happy to talk with you a little bit more. Gary, I had a question here for you.
Yeah.
When it comes to the capital appreciation of Vancouver, do you see it slowing down at all? It's just had such a great 15-year run of numbers that exceeded the Canadian average. Do you see it slowing down? Do you think that we're a high? What's your opinion?
I don't see it slowing down. I did a seminar maybe like 7 years ago at Langara, and people are asking me whether the foreign buyers are going to stop and whether like the money's going to stop coming from China and everything. And I said, when the economy is doing well in China, money comes out and they invest in Vancouver. When the economy is doing poor in China, they take their money out either. Also, so either way, they want to take their money out of China, and they want to put it in some area that's safe and politically safe and stable. And Vancouver happens to be one of those cities. When
Yeah.
I look at, so you and I, we've done the real estate investment seminars, we've done the real estate investment training. Everyone knows it's all about demographics and the economy. If the economy is doing well, the job growth is good there, the GDP is good, then when there's job growth, sorry, when the GDP is good, there's job growth. When job growth, population, oh, sorry, GDP, then population, then job growth, or sorry, no, job growth, then population comes, then vacancy decreases because with jobs and population, people want to move to the place and there will be a low vacancy. Low vacancy, that means the rental rates will increase. When rental rates increase, then people are like, oh, I might as well buy a place because it's cheaper. So they buy a place. And then when a lot of people buy the places, buy the homes in that area, then prices go up. So I don't see anything when it's all about foundation. How's the GDP of Vancouver and British Columbia?
I agree. I agree. And Gary, I have clients who have started in Vancouver and have moved away from Vancouver, mostly for economic reasons or a job opportunity with higher pay. And all of them commented the same thing. They all want to come back. And if our market suddenly started to dip significantly, and then we think, oh my goodness, we're crashing, you're going to get a flock of people who are now jumping back in. And when they jump back in, they're going to drive the prices back up.
That's right.
I also don't see anything more than a minor correction lasting. You have so many people in the condo market in Vancouver who want to upgrade to a house. You have so many people in the rental market who want to jump into a condo. I've got an enormous amount of clients who are all talking real estate with me who are either wanting to upgrade, buy more, like investment property, or to try to get into the market. None of them are saying, oh, I'm just going to stay on the outside or I'm moving away. So from my perspective, I cannot see it going down. Gary, I do have another question here for you. Okay, what do you think about investing in a new property in the West End right now? So of course, new property will be a bit more of a premium.
The reason why I like older properties there is because of the latent value. So I like to invest in lower, like a low-rise condo in West End, so that when it gets bought out by a developer, I will get 2 to 3 times asset appreciation. 2 to 3 times of tax assessed value. So whereas, the property will appreciate whether I just, let's say it doesn't get bought out, it'll appreciate. But then I like the multiples.
Yeah.
So that's why I like West End. If I buy just a condo downtown, I know it'll appreciate maybe 5 to 10% per year over the next 5-10 years. But if I buy a property in like a low-rise condo in West End, I'll probably appreciate 5 to 10% every year for the next 10 years. But there's a high probability the developer would just buy the building. And then all of a sudden it's not 5 to 10%. It could be like 50 to 100% asset appreciation.
I agree. So I guess the question over here, I'd like to chime in. It says, it depends on what you're investing for. Are you using the word investing as in you're not going to live in it, you're just parking your money and you want something to go up? Then I would agree with Gary. But because I deal with a lot of clients myself, I always ask them, is this a place that you want to live in? It's your dream home. You've always wanted to live in that neighborhood.
Exactly.
Perfect building. It's the perfect everything. Well, that's different. That's different because now you're saying, well, is it a solid investment? Yes, over time. If you were to try to rent it out, it's not going to cash flow unless you're putting quite a long down payment. But if it's a place you're investing for your own home, is anything that's going to cause us to say, don't buy it because it might go down? No. But if it's an investment, a pure investment, which you're not going to live in, I agree with Gary. Let's look for that multiple.
Yeah, like the short answer is it always depends on your risk tolerance, depends on your time frame, depends on whether it's investment versus comfort, a lot of reasons.
Sure. Okay, so here's our next question. Regarding the Strathcona/Railtown area, some developers have been holding lots in particularly the Clark and Hastings area for some time. Is it better to wait on purchasing there? What do you think, Gary?
I think it's a long-term play. I know a lot of big time people like Chip Wilson bought a lot of properties on Hastings all the way to SFU, but he has deep pockets, so he can just sit there for 5, 10, 15 years. So it's like buying land, kind of speculating. But it's I think those are good areas. But it really depends. Like I said, what's your time frame? Let's say you just want to park money there for the next 20 years. Then yeah, sure. Clark and Hastings, great area for like the next 20 years, right?
Those areas over there, are we talking that there's already some condo developments that you could rent out there? Or are you just talking about the just land that's there?
There are some industrial. There is also some condos there, but not like maybe older, like there are a lot of lofts and stuff like that there that potentially will be redeveloped, but not in the short term. So like St. Paul's is something that you can see in the next 5 years, but
Yeah.
like maybe Clark and Hastings, that could be 10, 15 years.
Got it. Got it. I understand. I understand. Okay. Last call for questions. I just want to be mindful of our time over here. Was there any last questions? Okay. So when you guys are ready to connect, and here is our contact information. So for those people who need to get financially organized, maybe you're sitting on the fence, you've been talking with your spouse about investing for a long time, but you've done nothing about it. Or you're trying to upgrade, or maybe you're not even sure where you are financially. Are we on track for retirement? Or we've been meaning to really, really get our finances in order. We've got some money, why aren't we doing anything with it? And is real estate an option, or should we stick with our RSPs? Now's the time that maybe you and I should have a talk. Like I said, my discovery meeting is completely complimentary. I'm there to help you. If I can just give you some really good information and you run away with it, that's fine with me. But if you need me, I'll show you how we could work together. So you would reach me out, or you would reach me at assistant@latitude-west.ca. And my assistant will set up a time for us to talk at some point here in July or August. And for Gary over here, you could reach him at info@garywongrealty.com. You could also find him at www.realestate vancouverrealestatetv.com. Is that
So that's my YouTube channel. And so if you want to go to my website, it's just www.garywongrealty.com. And I wanted to chime in, Christian, because you're the first and only financial planner that I know that really takes an emphasis on real estate. I meet a lot of clients that talk to me about like, I have no idea whether I should sell first or buy first. I have $1 million to play with. And I find that their financial planners have not guided them correctly or have even mentioned real estate. And so I'm glad to have met you and like somebody who can provide the financial advice, because prior to meeting you, I was providing the financial advice to my clients, but I didn't know the details. So they only gave me bits and pieces. So I kind of gave them a vague plan of, okay, you have $1 million. This is some options that you can play, but I don't know their specific financial situation, their debts and liabilities, and so I'm so glad to have met you, Christian. I think now I can refer those people to you to be
you
able
know
to provide the analysis that they need.
Exactly. And I think that's sort of my story as well. And that's when I got into the industry over here. And I thought, well, I've created the majority of my wealth through investing in real estate. Now I'm providing this financial advice, but why am I not talking about real estate, especially when it's not as complicated as people think? And it's also what many of them already were interested in.
Yeah.
So I think my practice is a little bit more unique. And if those people out there would like to talk to somebody who's a little bit different than their traditional financial advisor, I think that we should talk. I think the value that I bring is going to be far, far, far more than what you're going to find elsewhere. Not to throw dirt on stocks and real estate, stocks and mutual funds and things of that sort, but I just sort of find that you're losing out on the leverage effect, that the fact that the bank is going to lend you 80%, and in 25, 30 years, you're going to own 100%. And the entire time you're going to have a renter that helps to pay this thing down. And come retirement, that renter is now essentially giving you heavily cash flow, which cannot be outlived. You know, so, but I could go on forever to keep talking about that.
Yeah.
But anyway, to be mindful of time, I hope everybody could join us on August 14th. And please reach out to either Gary and or myself if you want to talk further. Gary, thank you so much for joining us, and I look
You're
forward
welcome.
to our next talk.
Yeah, thank you.